Friday, October 3rd, as most of the nation learned today, Ben Bernanke, retired chairman of the Federal Reserve, was turned down for his refinance loan application. And I have to confess, I did it. But to better things. The copy beside this video describes a global deflation event that's underway and the domestic consequences as the deflation storm overseas washes up on our shores. We're in better shape than any place else in the rest of the world, but we are not proof against the rest of the world's deflation. And since this is a family publication, I thought I would slow down and try to explain the currency mechanism that loses everybody. If I am Europe or Japan and I am in a condition where inflation is so low that people can't pay their debts back, people borrow money, but the money they have to pay back costs more than the money that they borrowed in the first place. Merchants in trouble because prices don't rise at all. A little inflation over a long period of time is beneficial. The people who want to take inflation up to 4 and 5% are crazy, but the Fed and central banks have it right that 2% or so, 2.5%, to have ascending prices means that debt levels gradually fall over time, as do their payments. Once in deflation, it's very hard to get out of it. The remedy for deflation is to have people spend more money. But in deflation, or at the edge of it, a dollar is worth tomorrow the same as it's worth today. If deflation takes hold, a dollar is worth more tomorrow than it is today, unspent, so why spend? Central banks are trying these exertions of printing money domestically. The Fed here stopped because our economy is better. Europe is flinching for the problem, and its reward is closer and closer to deflation. Year over year, European prices rose 0.3%. That's deflation. Japan has been in outright deflation off and on for 20 years. So a last-ditch effort to try to get inflation going in Europe and Japan is to artificially weaken their currencies. If they weaken their currencies, the cost of everything that they import rises. Now that's cost-pushed inflation. Oil worldwide is invoiced in dollars. It's not invoiced in euros or yen. So you have nearly 10% devaluation in both of those currencies. Oil prices have come down a little bit, but their currencies have gone down more, so energy prices cost more. But everything that they import goes up in price. Domestic inflation. The value of everything that they export overseas goes down in value. It becomes cheaper for other nations to buy, which theoretically will stimulate their economies and pull volume out of them. And here, on the receiving end, everything that we buy from overseas goes down in price, including the labor component of something made overseas. If you buy a pair of Nikes, the import price has gone down, meaning a worker here in the United States faces overseas wage competition through the Nikes that we buy. So we get the benefit of lower inflation, but inflation here is already so low that it's almost troublesome here. This interlocking world, globalization doesn't mean anything, but the opening of the world to international trade and the opening of currency markets to very fluid electronic flows means that we all feel each other. And as we close today with good job numbers here in the United States, the devaluation in place in the euro and the yen just this summer probably takes a 0.5 percentage point off of U.S. economic growth next year. Things are very good here, but we feel the beat of waves coming ashore from overseas. Do have a good weekend.